Hello students and welcome to Finance for Engineers course. In last lecture, we have discussed about net present value and profitability index used to take investment decisions. With the help of these techniques, one can evaluate the investment proposals or a project and can suggest the company which project or proposal is profitable to them. Today we are going to see the next technique under discounted cash flow criteria, that is internal rate of return method. Internal rate of return measures the rate of return of projected cash flows generated by capital investment. The IRR for each project under consideration by business can be compared and used in decision making. This method considers time value of money and it tries to arrive to a rate of interest at which funds invested in the project could be repaid out of the cash inflows. It is nothing but the discount rate that equates the present values of cash inflows with the initial investment associated with a project. That means it is the rate of return at which the net present value of a project becomes zero. See, calculating the internal rate of return will show if your company made or lost money on a particular project. The IRR makes it easy to measure the profitability of your investment and to compare one investment profitability to another. IRR calculations rely on the same formula as NPV does. Keep in mind that IRR is not the actual rupee value of the project, it is the annual return that makes the NPV equal to zero. One primary use of this IRR method is to determine in advance whether or not a project or large expense makes financial sense for your company. Therefore, many companies calculate the expected or projected IRR when analyzing one or more potential projects. If IRR is better than average or it exceeds your company's cost of capital, then invest in the project. If choosing between multiple investments, you can choose the investment with the highest IRR. Here you can see the formula of calculating IRR. IRR is equal to A plus into square bracket C minus O divided by C minus D bracket complete into B minus E. Let us see what is A. A is a lower trial rate. B is a higher trial rate. C is nothing but the present value of cash inflow at lower trial rate. D is present value of cash inflow at higher trial rate, whereas O is original investment, or we can say cash outflow. And here, accept reject criteria is we can accept a proposal when IRR is greater than required rate of return. So for better understanding of IRR, let us try to understand this with the help of an example. If your company's cost of capital is 6%, then any investment or project that will yield an internal rate of return higher than 6% is feasible. If your company is presented with an opportunity to purchase long-term treasury bonds at 4%, this IRR of 4% is below your cost of capital and therefore is an unwise investment. However, say another investment opportunity arises, which, upon further analysis, your accountant determines will yield an IRR of 10%. Your company should invest in that project because the internal rate of return exceeds 6%. The internal rate of return is the annual rate of growth that an investment is expected to generate. Generally speaking, the higher an internal rate of return, the more desirable an investment is to undertake. IRR is uniform for investments of varying types and as such can be used to rank multiple prospective investments or projects on a relatively even basis. In general, when comparing investment options with other similar features, the investment with the highest IRR probably would be considered the best. So let us see an example how to calculate IRR of a particular project. The same example we are again taking here for calculation of IRR, that is of Beta Private Limited Pune is considering an investment proposal to install new mining control at a cost of rupees 50,000. The facility has a life expectancy of 5 years with no salvage value. Tax rate is 35%. Depreciation method is straight line. And the next is given information about the cash flow before tax and depreciation. And you are required to calculate internal rate of return of the proposal. So how to calculate this? Here, for solution, you have to keep in mind first to prepare same statement which shows cash flow after tax before depreciation. That means again we will prepare this table which shows information concerned with particulars and 5-year data. In particulars, you can see cash flow before tax, the information given in an example. Then we deducted depreciation, which we have done in all the 4 methods earlier, which we have seen, since from payback method to ARR, then NPV and PI. So calculation of depreciation, and the method is straight line method. Then deducted depreciation, we arrived at PBT, calculated tax at 35%, and then we got PAT. Again, we are adding back depreciation, and thus we arrived at cash flow after tax before depreciation. So this thing remains common for all the methods except ARR method, except accounting rate of return method, where we never add back depreciation. And then next is calculating IRR. Now here they have not given any cost of capital or discount rate to us. And for calculating or for identifying internal rate of return, we need to have rate of return. So by a trial and error method, we will assume some percentage as a lower trial rate and another percentage as a higher trial rate. And by applying the same formula which we have used in net present value method, we will try to calculate present value of cash inflow after tax before depreciation. So let us calculate it. So present value of cash flow at 5% discount rate. This is we have assumed. It is not given in an example. So you may be having question that how can we assume which rate can be taken here? So normally for a lower trial rate, we can consider 5% and higher trial rate can be 10%, 15%, 20%, whichever is you feel to take over there as a higher trial rate. So I have taken 5 and 8% as a lower and a higher trial rate respectively. Okay, so this is a formula which is we have already used in a net present value method. So by this way, we will calculate present value of cash flow at 5%, that is lower trial rate. And then next is present value of cash flow at 8%, that is higher trial rate. Again, same formula we are going to apply here of net present value. And then this is a formula of IRR. By putting figures over there, we can see here A is lower trial rate, so 5 is written. Next is C is present value of cash flow at lower trial rate minus O, that is original investment 50,000 divided by again present value at lower trial rate minus present value at higher trial rate into P is higher trial rate minus A, that is lower trial rate, that is 5. So in this way, we will solve the equation and we arrive at 6.64 percentage. This is the internal rate of return of this particular project. So it is somehow less than the higher trial rate. So 6.64% is very less amount, and we can suggest that this project is not profitable as the IRR is less. We don't have any other project to compare with this, but looking at this particular figure also, we can see that this is a low amount. So companies should not accept this particular proposal. If they have not given us information concerned with a lower trial rate and a higher trial rate, we have assumed that 5% as a lower trial rate and 8% as higher trial rate. But in certain cases, sometimes they give us information concerned with lower trial rate and higher trial rate. They provide us the discount rate at 5% and 8%. Then we can put the data in this particular format and can apply the formula for calculating IRR. So in this particular table, you can see first column is year, second is cash flow after tax, then present value factor 5%. It is assumed that it is given in an example, so it is ready-made with us. So I have put that in that column. Next is total present value. How this calculated? Just multiplied CFAT with that present value 5% discount factor. and we arrived at total present value at 5% trial rate. The next column is again CF80 and present value factor at 8% and total PV, that is multiplication of two columns, CF80 and present value factor at 8% will give us total present value at the 8%, that is higher trial rate. And by application of this particular formula again, we get IRR 6.64%. So this is about how to calculate IRR. Now the next part is concerned with decision tree. So what is a decision tree? A decision tree is useful analytical technique in capital budgeting to evaluate risky investment proposal involving sequential decisions. That means when huge amount is required to get invested in a particular project and we have risk over there, that means we are not sure that the project will be successful or not. And in that case, normally decision tree approach is used by the organization to take capital budgeting decisions. A visual representation of choices, consequences, probabilities, and opportunities included in this particular decision tree. It is a way of breaking down complicated situations down to easier to understand scenarios. The technique enables the decision maker to study the various decisions points in relation to subsequent chance events and choose from among the various alternatives in an objective and consistent manner. Since the format of problem of the investment decision has an appearance of a tree with branches, the method is known as decision tree method. It shows the magnitude, probability, and interrelationship of all possible outcomes of an investment proposal. In a nutshell, a decision tree is a graphic display of the relationship between a present decision and future events, future decisions, and their consequences. Next is, there are some notations used in decision tree. You can see here a box which is used to show a choice that the manager has to make. You can see here a circle which is used to show that a probability outcome will occur. And next is line outcome, which connect outcomes to their choice or probability. So these are the notations used while showing any decision in the form of decision tree. So we will take an example, a very easy example. A decision tree with two choices. This can be related to you. You can also think yourself. That is, you may have two choices: go to B school to get PG degree of MBA, or go to work in a real world. So you have two choices, and what things you need to consider while choosing any one of it. So what are some of the costs we should take into account when deciding whether or not to go to B school? So what are the important points we need to consider here? First is concern with B school, tuition and fees, rent, food, etc., opportunity cost of salary, and anticipated future earnings. So these are certain things we need to consider while taking this decision. So how can we present it in the form of decision tree model? So first decision is concerned with go to B school to get MBA degree, and second decision is go to work in the real world. Now further we identify various important aspects which we have jotted down earlier slide. That is 2-year tuition, rupees 55,000. It is an assumption. Then 2 years of room or board expenses, rupees 20,000. 2 years of opportunity cost of salary, rupees 1 lakh. Total is rupees 1,75,000. Plus anticipated 5 years salary after business school, rupees 6 lakh. So now let us see net present value. If we join or if we go to B school for getting MBA degree, what will happen? You will earn 6 lakh minus the expenses or cost 1,75,000. So net present value here is rupees 4,25,000. This is an example just to understand how normally we can take decision with the help of decision tree. How can data be presented in the form of decision tree? Next is if we choose to go to work in the real world, then first 2 year salary, which we have considered above, rupees 1 lakh, minus some expenses. It can be concerned with again traveling expenses or again rent and all, rupees 20,000 in total. Final 5 year salary will be rupees 3 lakh 30,000. So if we never go to B school, then NPV is rupees 4 lakh 10,000. So here, which one to choose? Definitely, by looking at that particular thing, you must have understood that going to B school is profitable than to choose go to work in a real world. So now let us see another example concerned with Mary's factory. Mary is a manager of a gadget factory. Her factory has been quite successful the past 3 years. She is wondering whether or not it is a good idea to expand her factory this year. The cost to expand her factory is rupees 1.5 million. If she expands the factory, she expects to receive rupees 6 million if economy is good and rupees 2 million if economy is bad. If she does nothing and the economy stays good and people continue to buy lots of gadgets, she expects rupees 3 million in revenue, while only rupees 1 million if the economy is bad. She also assumes that there is a 40% chance of good economy and a 60% chance of a bad economy. The probability is also given here, and you are required to draw a decision tree showing these choices. So how to present the given information and identify which decision is good. Let us see. So two choices are there. First is expand factory and cost is rupees 1.5 million. And if you don't expand factory, cost is zero. First probability is 40% chances of a good economy. Profit is equal to rupees 6 billion, which is already given in an example. Next is 60% chance of bad economy and profit is 2 million. Again, next is 40% chance of good economy, profit is rupees 3 million. Next is bad economy, profit rupees 1 million. So now, by calculating net present value, if she take a decision to expand it, her net present value we can see will be rupees 2.1 million. You can see here the calculation shown. Next is net present value if she takes the decision not to expand is rupees 1.8 million. So finally, we can suggest that rupees 2.1 million is more than rupees 1.8 million. You should expand the factory. This is the decision which we can suggest to the Mary. So in this way, we can present data, we can put figures and can take decision. Here you can see probability is given in a problem and risk is involved in this particular project. Therefore, decision tree helps to take decision concerning to which one is acceptable, profitable. So decision tree is useful method of risk analysis. We can see the probability of occurrences for various outcomes and the interrelationship between the outcomes. It is useful in various circumstances like handling the sequential investments, working backwards from the future to the present. The decision maker is able to eliminate unprofitable branches and ascertain optimum decision at various decision points. Also, this approach clearly brings out the implicit assumptions and calculations for all to see questions and revise it. The decision tree enables a decision maker to visualize assumptions and alternatives in a graphic form. This is usually much easier to understand. But there are some disadvantages also associated with this decision tree analysis approach. That is, the diagram of decision tree analysis become more and more complicated with the inclusion of more alternative variables and by looking into a very distant future. Complications increase still further if the analysis is extended to include interdependent alternatives and variables. So always there are some pros and cons with a particular method. So by looking at the advantages, disadvantages are very less. So depending upon the decision, one can use various techniques for taking investment decisions. So students, here I'm ending my session and we have completed our fourth unit. In next session, we will start with our fifth unit concerning to long-term sources of financing. Thank you.